Hello everyone, today is Friday, December 23rd, 2022. My name is Evan. Welcome back to another edition of Stock Market Weekly, perhaps the last one of the year, episode 663, presented by the Trade Risk, where it is our job to break down the most important trends, price action, and noteworthy moves across financial markets. If it's your first time tuning in, first off, welcome. Thanks for being here. We break up our analysis into two parts. So in part one, we look through the numbers and we pick apart everything that stands out, looks a little bit different, interesting, or notable. And then in part two, we jump into the charts. We look at those trends and take a deep, close look at price action. So hopefully that sounds good to you. And before we get too far into it, I want to wish everyone a Merry Christmas, Happy Holidays this season. We got markets closed on Monday and a short week to wrap up a extremely volatile, turbulent roller coaster year. And I want to just thank everyone for tuning in and wish everybody the best. It's been a difficult year out there. If you're finding your account balance lower at the end of the year than it is at the beginning of the year, you're not alone. It's been difficult out there, but hopefully these videos have been helpful for you, give you a little bit of clarity, guidance, and maybe some objective analysis in your week-to-week trading. So let's get into it here. In this week's episode, we've got tech underperformance continuing here. So the theme throughout the year is basically just exaggerating or on full display over this past week. We see the Nasdaq really underperforming here on a relative basis. The generals. So this is, I posted a chart today and Tesla is obviously flying around everywhere. Charts, news, stories, headlines. It's basically on everyone's mind here as it falls from grace and really is plummeting to fresh new lows on the year and multi-year lows. And so we sort of ask ourselves here, are the generals finally being kind of shot? And that's an old saying basically throughout history where the market leaders, where the leadership really concentrated in the last market uptrend. When those finally start to break down and sell off, that might be your last leg in the in the pain, right? In the bear market. Now, of course, nothing's absolute. We're not making some big stance here that says, yes, absolutely, the bear market's over, but it just makes you wonder, and we want to talk about it. And that's what we always like to do here, is kind of frame out both sides of the argument. So we'll talk a little bit about that in part two. We got gold continuing to chop sideways, some interesting action there. Commodities waking up a little bit, specifically on the ag side, and we see a bond market continuing to sell off here into year end. Now, if we take a look at the numbers, you can see this week really depended on where you were. So world stocks minus the United States, this outperformance on a relative basis, we've been talking about it for several weeks now. I know a lot of folks are very US centric, and that's fine, but just keep this in mind that this trend has been, kind of continuing to emerge here, that there are pockets of strength, at least relative strength, outside of the United States going on right now. That continues. ACWX proxy that we're using here for this in particular, it was up 0.5% this week. But if you look at the S&P or the Russell, you were basically flat on the week. There was a lot of turbulence, so we kind of drove off of the lows. But the Nasdaq is that underperformance there, so it's down 2% this week. So if you're concentrated in tech still, then you're certainly feeling some pain this week. Now, if we take a look at the overall trends here, we still have a very mixed picture. We got this ugly kind of sandwich going on here. The 10 SMA is declining across the board, so short-term trends are down. The 50 SMA, though, is rising in the S&P, in the Russell, in world stocks here. So everything but the Nasdaq is seeing a rising 50-period simple moving average. So that's that medium duration. And of course, on the long-term side, we still have declining 200-period SMA. So you've got a very mixed bag there, and it speaks well to some of the cross currents that are still out there. Now, in terms of volatility, it was at least a little bit positive that we're seeing the VIX continue to, kind of fall back down. It had a big surge to the upside last week. And at the start of this week, we saw a VIX jump, but by the end of it, we did fall about almost two points here in the S&P VIX. Nasdaq vol was down 1 point as well, which is again surprising given the fact that we had a 2% down week for Nasdaq 100. We still saw volatility fall this week. So again, that speaks to some of this vol compression here that we just continue to see. There seems to be very much this drag to the downside here on volatility. Russell vol was also down 2 points. Now, if we look at market internals, this is still where, you really can't get too excited if you're a bull here, because we still just don't see the number of highs materially, ticking up. We talked about this a couple of weeks ago. There's a lot of chatter and excitement out there that breadth was improving, but we didn't really see it in the 52-week highs and lows. Yes, on margin, it was, it was a little bit better a few weeks ago, but it still wasn't anything that got us really excited. And we're still seeing this, overpowering number of lows over number of highs continue to take place here in the NYSE. So this is still, very much lackluster, bearish to sideways to down in our overall trend here. Now, if we take a look at sector performance this week, energy back to being a standout to the upside. So remember, energy really got hit pretty hard over the last month and prior weeks, but it's starting to stage a little bit of a rebound. It was the brightest spot this week. Financials and utilities were in the second and third spot, closely followed by staples. Now, on the downside, consumer discretionary, XLY, the reason this is so pummeled this week and over the past month is the heavy weighting in Tesla, which sort of dominates some of the activity here in the XLY. Technology and real estate were in the second, third worst underperforming sectors. Now, if we go to IBD industry rankings, and IBD is a sponsor of our show here, so thank you, IBD, and for everybody that may not have a subscription going into the new year, check out IBD Digital. You can use this link here, support the show, and they update these tables. They update many tables, but this is just one of them. And there's a couple of interesting things going on here. I mean, basically, what I generally speaking like to look at is kind of 3 weeks ago versus this week, and you start to see a lot of these things creeping up here. So 3 weeks ago, steel was not on this list, and it's jumped to the number 10 spot. So we got steel producers, so commodity producer basically, which is hit the top of the list here. We got machinery, so again, industrials. We got commercial services, leasing. So you're getting this very industrial sort of brick and mortar, for lack of a better term, sectors and industries starting to creep back up, computer hardware and peripherals. So you can see all of this. You can take a look at this and kind of judge for yourself on what looks interesting to you, but certainly drill into those industries, which are, again, a subset or more specific than some of the sectors that we just talked about. Now, if we take a look at correlations here, look at this bright green across all of the equity markets. So basically Dow, SPY, Nasdaq, Russell, all, basically being treated as risk on, risk off all at once. Of course, we did talk about the more granular Nasdaq underperformance, but generally speaking, all of these are trading in lockstep with one another. What's different and a little more interesting now is take a look at the dollar correlation here, UUP. This has basically been negatively bright inverse correlated to what's going on with risk assets. Essentially, the dollar has been driving the action, but that's not the case now. In fact, you're actually getting, for the first time in quite some time, a positive correlation here for what the dollar is doing in stocks. So basically, we've put that in translation, we're seeing stocks down, dollar down, and that is a bit unusual. That's not the script that we've seen for most of this year. Now, again, I want to remind everyone these are 10-day correlations, so they are inherently short-term, but it's still noticeable and notable. And that 10-year interest rates, the yields there also, still showing some inverse correlation, but much weaker. Now, in terms of interest rates this week, everything was up across the board. That's some of the theme we're seeing here into the last couple of weeks of the year. We were, for a period going into the start of December, seeing this nice move higher in bonds, and yields were coming down, but now we're starting to see a kind of reversion back to the dominant trend. We're starting to see treasury yields tick back up to the upside. We've got the 10-year now up around 3.75. It was all the way down below 3.5 last week, and it's starting to tick back up. So certainly not the most bullish thing here when you start to see interest rates climbing back up to the upside. Now, if we take a look at dollar dollar and commodity performance overall, we saw oil up pretty substantially this week, 6.81%. That was at the top of our list for commodities. Silver up 2.25%. DBA, which is the agriculture ETF, we're going to talk about this in part 2, is up 2.25% as well. Copper was up. Bitcoin was up, but basically flat. Gold flat, but up. Dollar was down, and natural gas totally standing by itself, 21% to the downside. Extreme volatility, as it always is. Natural gas is a beast, and it was certainly on full display this week. Now, last but not least, our positioning here. So we run kind of a short-term swing trading system and a medium-term swing trading system. And you can see that both of them are actually long right now. Merlin's got more of a defensive positioning still, even though it's showing 18% long. A lot of that's hiding out in dollars. But our short-term system has been more attacking on the long side, which is something we haven't really seen for a while. But it is, marginally out there looking for some lower risk opportunities on the long side of this market. And it's actually been doing a good job at locking in some small wins. So overall, mildly bullish, but still very cash heavy in both of our swing trading systems. If you want to learn more about these two trading systems, check out the trial we have on our website, or you can just read more about the performance and how these systems work on our website as well. You can start the new year fresh with some fully rules-based and objective trading systems. So that is it for part 1. We'll be back here in just a second with part 2. All right, let's jump into the charts here. We've got TC 2000 open. We've got the S&P 500 cash settled market. We're looking at a daily time frame. We're going to start our analysis on this old familiar grid here that we've been looking at for quite some time. Now, S&P 500 on the week, let's actually kick it to a weekly chart. We're going to start here. And I think notably and kind of interesting, let's drop this off to give us a little more room, is basically, last week we saw a tremendous amount of volatility, of course, and a move all the way up to 4,100, which was quickly rejected. But basically a big tail on the upper end of the week. So last week we had just basically big, clear rejection at those highs above 4,000. And this week, we closed last week on the lows. And this week we saw some initial follow through lower all the way down to about 37.65 or so. And again, rejection off of the lows and a close up towards highs. So on a weekly perspective here, we've got just big tails and good range taking place here in the S&P 500, but we're still, rejecting the extremes, let's call it, from the weekly ranges. Now, if we go down to a daily chart in the S&P 500, couple of things to note. First off is we remain underneath 3,900, which is been one of our key levels of inflection that we've been talking about for about 6 months or so, ever since May, frankly, when the market, really showed us that it cared about what was happening here around 3,900 with those early, summertime or late spring buyers, kind of finding value around 3,900 and under. And the market, ultimately started caring about this every time it got towards these levels. It provided support and resistance points for the market. And so that's why we care here. Now, this also happens to coincide with the recent 1 month range throughout November and early December. So we had basically this 5-week period where the market was chugging sideways, making up its mind on which way it was going to go, failed at the highs, and then saw a fast move lower and broke below 3,900. So the very, very high level, upper level analysis here is, be cautious under 3,900, be optimistic over 3,900. I mean, you can really make it as simple as that. And that's the whole point this year of such volatility, is we've been using these very clear kind of bands of horizontal support and resistance. And that's been guiding most of our decisions. And I think our decisions have been, not perfect, of course. And there's been some whipsaw along the way, but they've been great spots to manage risk against if you're acting on them. And so I continue to believe 3,900 is going to be an important psychological zone for the market. Right now, we're just consolidating underneath it here. So it's going to be interesting to see if the market can, in fact, muster up a little bit of a higher low here. Now, it was a week ago, I think we were right in here on the Monday, I posted a chart basically, kind of pointing out we were below the lower Bollinger Band here, and basically making the case, wouldn't it be interesting now that we sold off hard for 5 days, broke below the lower Bollinger Band, broke below the key 3,900 support. We got everyone bearish, sucked in everybody on the short side again. We came back and filled the gap. Wouldn't it be interesting to see some type of higher low get put in and then just a fast move back over 3,900 to really push everyone off sides? Now, hasn't quite happened yet, but hasn't quite been invalidated either. There's just been a lot of chop in here. And of course, again, with Thursday's session was notable because, again, we traded all the way down to 3760. We were off about 2.5%, almost 3% on the day in the S&P 500. And we came kind of roaring back up to close up here and back above the Tuesday, Monday lows. So as it stands right now, the market is once again in this consolidation phase, and it is got 4 days going tight and sideways here between 3,800, let's call it, and about 3,880. We're still waiting for some direction here. Again, I think we have to be cautious under 3,900. That is the benefit of the doubt right now to the sellers. But if we do punch through this, if we can find some follow through, and if we can get buyers to kind of step in here and push us back over 3,900, look out to the upside if we can reclaim this range and then start doing some more repair work to the upside. So that's the way I'm looking at it, keeping things pretty simple, but basically watch this 4-day consolidation, watch this range here. And again, we're getting markets that are very cleanly responding to technicals here. There's tons of headline noise, tons of worry about this and that and the Fed and the economy and slowing earnings, which I'm not dismissing as they're not important. It's just that there's too much information out there. And so we go back to basics and we think about technicals and what the price action is telling us. And to me, we've had just some textbook technicals here lining up, breakouts, consolidations, back to the basics, and they've served us well, I'd say, on navigating these markets. So let's continue with it and let's pay attention to these levels going forward into what should be a very light volume week into the year end here. And we'll see what happens. If we go to the Nasdaq 100, again, this looks a lot different, a lot less optimistic, a lot less exciting. This is more clearly in the bear case here because this broke below this 280 zone that we, again, have been talking about for quite some time. But this has just been dragging lower here. So there's been no sideways consolidation. There's been no attempt at a higher low. There's been no attempt at some resiliency. It's just basically been a slide lower here, not quite towards the October lows, but we're not far off. In fact, we're only about 4.5% away from new drawdown cycle lows here in the Nasdaq 100. So the picture is much more pessimistic when you think about the tech-heavy Nasdaq 100. Now, if you go to, say, the Dow Jones, which I know we don't typically put in rotation, maybe we need to, as this index has been more, where the action has been. I mean, this is such a different picture than basically everything else. The Dow Jones is still 15% from its October lows. I mean, this is drastically different look than anything else. And so basically, kind of what we're seeing again and again is the further you remove yourself from tech, the better your relative strength tends to be, right? The better strength that you've seen recently or even throughout this year. And so the S&P 500 obviously has more tech in it. Dow Jones, almost no tech, depending on how you want to classify tech. It's got Apple in it, of course. But and then you look at the Russell 2000, and the Russell 2000 is just comfortably in the middle of a very sideways consolidation here. And again, this just seems to be the most messy sideways market of them all. Probably a good market to sell iron condors or some option selling premium on the extremes, but basically here sitting in the middle of the range and pretty directionless. So that's really the roundup there. Tech being the worst and Dow Jones obviously being the outperformer there. But let's keep an eye on, we'll say those S&P 500 levels that we talked about at length. So that's the read on the major markets here. If we take a look at volatility. So if we go to the VIX here, you can see again the VIX was down almost 8% on the week, and again we had markets lower, right? We had equity markets lower, but we had vol continuing to kind of come out of this market. So you've got just really a volatility regime that feels like it wants lower here over, you know, the past few weeks. If we take a look at gold and we look at this weekly chart, take a look at the topping tails here in gold. So GLD, you can see back-to-back sort of rejection up here above 169 or so. It's had a heck of a run since early November, so there's no, you know, big issue here. The fact that it's hanging in and still well off of the lows is a good thing, but it's certainly, struggling a little bit around 169. So let's give it some time and let's see if we can put in some type of higher low or longer consolidation. And if we look at, let's see, what else was on my list for us to look at. TLT, kind of seeing a breakdown, convincing breakdown week this week, down 4.62%. That's a big week for TLT. You can look at IEF as well. So essentially here, we've had this nice period of a counter trend retracement bounce in bonds, and now they're starting to roll over a little bit. So we're going to need to keep an eye on this. Is this, going to be a little bit of a pullback that finds support and then we can rally, or is this just kind of, reversion back to the dominant trend and higher interest rates are across the border are coming? That's going to be the big question as we go into 2023. Dollar here is still struggling to find its footing. Can't really do a whole lot. It ended up, breaking below the lows from last week, and it's again putting in some tails like it wants to try and hold, but it's still in process at the moment. And DBA, that was what I wanted to mention. DBA here is Invesco's ag ETF, and you can see it's got a pretty good look here. In fact, I did a little bit of I've used options to do some buying here in DBA. This is a very slow, don't expect to double your money anytime soon, but for a clean move here on a weekly chart, you're starting to get an uptick in volume as we break some of these recent cluster of highs, potentially put in a higher low. Uptrend is clearly intact here. So I put on a little bit of exposure here in DBA, nothing too tremendous. And again, I don't expect any massive moves, but we'll see if it can get some follow through and at least work itself up into the 21s, mid 20s once again. So that I think covers all of the majors. I did want to talk about Tesla because, again, this is what everybody else is talking about and thinking about. We've just seen, again, a really increased intense kind of selling pressure here in Tesla. We're going into year end. There's definitely some forces that are sort of exacerbating or exaggerating the move to the downside, but we're pretty much going vertical here. And again, let's just keep this in context. Tesla is not exactly a small to medium cap stock. You're talking about a company that formerly was almost $1 trillion, I believe, at the highs, but certainly even a month ago, 2 months ago, was $600 billion company, has shaved off a tremendous amount of market cap in a very short amount of time. We're seeing the selling basically go pretty much straight down. So definitely some liquidation, some fear, some funds, really either just getting blown up that we don't know about yet, or maybe some, folks looking to really pound the table here to the downside to get some of that performance chasing in a name that's spiraling lower and very liquid. Regardless, if we just look at the structure here, basically now we've got 3 weeks of increased selling volume. This week is the heaviest expansion in range, down 18% of selling in 1 week. And you can see over the past 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15. It's down 13 out of the last 15 days or so, give or take. So this has really been, a source of pain here. And this goes back to the top of the theme of this week, or the call to action here is potentially, are the generals finally being shot? Tesla's where was really the place that fueled. I mean, this was like the front poster child of growth and excitement and, relief here over the past 2 years was everybody crowding into this growth mania play of Tesla. And now you're finally starting to see the pain come in here and really see some liquidations and forced selling and people throwing in the towel into year end. So the question is now, is this the last domino that needed to fall, or one of the last dominoes that needed to fall before we can finally get some stabilization? We're all the way back to, basically September pricing or so, August, September pricing of 2020. So we haven't, fully gone back to pre-COVID levels or anything like that, but we certainly have done a good job retracing and pulling out of this mega cap. It's down 65% on the year, and this would be the biggest drawdown for Tesla, I believe, in the company's history. So that's certainly the story there. Quite oversold, but the trend is certainly on the medium term to the downside. So that, I think, is a great place to wrap it up there. Hopefully, again, like I said, these videos have been helpful for you throughout the year. Try and just give you an objective stance on kind of the bull bear case and let everyone come to their own conclusions based on their own strategies and time frames and so on. So with that, again, I want to wish everybody a Merry Christmas, Happy Holidays. Thanks so much for tuning in each and every week. I appreciate that, and look forward to trading with everyone in 2023. So thanks so much. Have a great holiday, and we'll see you back here potentially next week if I don't have too much travel. Otherwise, in the new year. Take care.